Good afternoon, everybody, and welcome to the Institute's latest national branch meeting. For those of you who might have been waiting for a minute, we just observed the 12 noon minutes silence that I think was being held today to sort of commemorate and honour the fact that we are a year into the coronavirus lockdown and pandemic. So hopefully you understand why we've started 1 minute late today. Welcome to everybody, the latest Institute branch meeting. It's a pleasure to welcome you this afternoon. From my side, just let me run through a couple of slides kindly before I hand over to today's speaker. As always, housekeeping. We say this every time, but please bear with us if there are any technical issues. We will look to resolve those as quickly and as expediently as possible. If, though, you are having sound or visual issues, can I just suggest you first check your own connectivity? We have found from experience that it's actually that connectivity that is causing the problems. How can you engage? How can you get involved today? Please use the Q&A button at either the top or the bottom of your screen. And please also use the chat facility. We will be hosting a small number of polls, questions, and as always, very easy to respond to those polls. Please do get involved. I will return to the screen when they appear, just encouraging and asking everybody to take part. But please use the Q&A facility to ask any questions today. If it seems pertinent at that moment in time, I will interrupt our speaker and ask them. If not, I will save them up for the end. For everybody's information, today's webinar is being recorded. Just really want to update all attendees of up and coming webinars that the Institute is running over the next month or so. Technology seems to be a big interest amongst the membership at the moment. So there are 3 up and coming technology-led webinars. Tomorrow, the IFA Books Plus webinar. On Thursday, the DEXT webinar, which DEXT, for those who are unaware, was formerly Receipt Bank. And on the 21st of April, BTC Software are hosting a webinar for members. There are 2 quarterly updates around accounting treatment, financial reporting to be aware of, the 25th of March and the 20th of May. A couple of charities-led seminars and webinars. A charities basic introduction in early April on the 8th, and a charities financial reporting webinar on the 6th of May. Our branch meetings, our national branch meetings continue into April, as there have been since February. There are 2 each month. There's one on the 13th of April, looking at financial distress and how to support clients in times of financial distress and potential insolvency. And on the 27th of April, an inquiries tax fee protection led webinar. The tax series continues. I know a number of members have taken part and I believe got great benefit from the previous tax series. The next series is on the 11th, the 18th and the 25th of May. I save one more webinar series till last because it's not a subject matter that we've covered before, but I think it's one that is incredibly important in these times, and I think it will remain an important topic for the months and the years ahead. We are running a series, 2 webinars centered around well-being on the 22nd and the 29th of April. I would encourage and suggest as many members as possible, please register for the 22nd and the 29th of April. An individual talking from a very personal experience. So there is a story and there is, if you like, a story that I hope builds trust and rapport with those attendees, that will be followed up with some practical hints and tips, as I say, around a very important subject matter. So there's some up and coming webinars for March, April and May. Just a few other matters. I remind everybody of the digital platform, www.financialaccountant.co.uk, a host of useful content, articles and information. As well as these national branch meetings, we do hold local branch surgeries, and they return again in April. Bristol, Manchester, Scotland, Northern Ireland, London, Crawley, High Wycombe, Milton Keynes, the Midlands, Leeds, Yorkshire are all holding local surgeries throughout April. Please do visit the website for dates and registration details. A final reminder from me and the Institute on the webinar series about the 2021 membership renewals. We've reminded members through various means over a number of months. I hope there's nobody on the webinar who hasn't renewed, but if you're wondering whether you have or haven't, please do look at your inbox. Please do make contact with the Institute and we can confirm whether you have or you haven't. There is the membership renewal, and where applicable, there is the member firm renewal. That is about payment of fees, but it is also about the completion of your member declaration and, where applicable, your member firm declaration. Any concerns, please do let the Institute know. Contact the membership team or myself, happy to help and support there. I've been asked previously as well about membership certificates, practicing certificates. We are and we will be getting those out to members in the weeks to come. Please bear with us because of the COVID situation. We haven't been in the office. We've all been working remotely, but we will be getting those out to members from the beginning of next week. If you need confirmation or clarification around any of your certificates, again, please do contact the Institute. We're only too happy to help. Enough from me, and on to today's guest speaker. Can I welcome Tom Elliott from Mattioli Woods. I do hope a good number of you will have had some form of engagement with Mattioli Woods, an Institute strategic partner for a number of years now. Mattioli Woods are a wealth management and employee benefits specialist. Tom is a senior investment strategist at Mattioli Woods. He joined the organisation back in 2020. I'm sure Tom can probably recount some interesting stories, having joined an organisation during, at the start, or maybe halfway between the pandemic that we found ourselves in. Tom has over 25 years investment experience working with financial advisors and asset managers, including 18 years at JP Morgan Asset Management, where he was an executive director and global markets strategist. Tom is very kindly giving us a talk, an update and an insight today around investing after the pandemic. As I've said, I will deal with questions if appropriate as we move through, or I will save them till the end. Please use the Q&A facility and function. But Tom, enough from me. Thank you for joining us this afternoon, and I will stop sharing my slides and allow you to share yours and to start, but welcome and thank you.
Thank you, Jonathan. Sorry.
No problems. Hi, Tom, are you okay? I think you might have frozen there. Oh, there you go.
Here we are.
There we go. Yeah.
Okay.
Slideshow, if you look at the slideshow, or from the slideshow and then from the beginning, go along a little further. So at the top, you've got file, home.
Sorry, it's been mute. File, home, insert, design.
Yeah, then if you click on slideshow.
Sorry, I've got design.
Yeah, go beyond that. So you've got transitions, animations, and then slideshow.
Okay, for some reason the sign for mute and the Zoom instructions are hiding those. Are you?
There we go. Right. Yes. So if you want to take yourself back to the beginning by scrolling up, that should be.
Okay. Are you just seeing one slide now?
No, that's fine. Yep.
Okay, I do apologize. In rehearsal, we did have this down to a fine art, but that's always the case, I think. So good afternoon, and thank you very much for inviting me to speak to you this afternoon. As Jonathan said, Mattioli Woods is a Leicester-based company. It's been going for 30 years, and it's got over 10 billion of assets, and we provide a whole suite of financial services to companies and to individuals. We're award-winning with several different branches, but a particular interest to me working in the investment management side is Morningstar has given a 5-star rating to our Adventurous Fund, which we're very pleased about, and I think reflects a lot of hard work that we've put into that. I'd like now to come to 2 polls that we'd like to do during the course of the afternoon of the session. The first is to ask, when do you think UK inflation will reach 2%? And I won't read out the answers. I see people already responding.
Good. Right. This is where I rejoin these meetings and encourage everybody to answer the questions, the polls, please. We've got a very good number of attendees today, so I'd really like to see everybody, or as many people as possible, answering. I think there's only a couple of questions, so.
Yes. So.
There we go.
Okay. So the majority think we've got the most popular is by the end of 2022, and over the course of this presentation, we'll be coming to answer that in terms of what the OBR are forecasting. And if we could have the next poll, please. I guess I turn to the next page.
There we go. Yeah.
When was the last assessment of the economic impact of Brexit published by the UK government?
Good to see them going up.
So I think that's fairly clear. 41% say December 2020, i.e. around or just after perhaps the signing of the trade deal with the EU, and it goes down, and 12% hovers far back as November 2018. Again, we'll be coming to these during the presentation.
Thank you.
And I'm now going to remove that and return to the presentation. So over the next 30 minutes or so, what I'd like to do is talk about the prospects for global growth as we come out of the pandemic and what's supporting the relative optimism amongst economists and financial markets for that growth. I'm then going to look specifically at the UK and why a lot of people think the recovery will take longer in the UK than elsewhere. And then I'm going to look at the interesting case of inflation, which is a friend to some, to debtors, which increasingly will include the UK government. But of course, the more that borrowers fear inflation, the more interest they charge. And the UK government is very nervous of interest rates going up and bond yields going up, and these huge deficits costing more to service and to persist with. And then I'm going to look at Brexit in a little detail, and then look at Matthew Wood's offering and talk about two themes that Matthew Woods, I must admit, in common with the rest of the financial community, are currently engaged in when we're doing asset allocation for our funds. And these are two rotation themes. The first is from bonds into equities, reflecting the growth we're seeing around the world. And secondly, within equities, from growth stocks, particularly tech, into what we call value stocks. And then there'll be a Q&A. So the first slide here, the presentation proper, is illustrating the fact that we believe that a combination of the rollout of vaccines around the world, plus very supportive fiscal and monetary policies from governments and central banks, will lead to a fairly strong economic recovery starting in the second quarter. Now, the vaccine rollouts are particularly good in the UK and the US. The US is really surprising. They reached 100 million vaccinations last week. Under Biden, they've really accelerated that program. And as you know, in the Eurozone, they're slacking. It's not quite as strong as we might have hoped. Fiscal and monetary policies, countries around the world are trying what they never thought they would do or be able to get away with. Who would have thought the bond market would allow the UK deficit to go from an estimated 40 billion at the beginning of last year? That was what the deficit was going to be for fiscal year 2020-21. It's now estimated that it's going to be 350 billion. And what's happened to 10-year bonds over that 12 months? Well, they went down, the yields, which and now they're more or less back up to where they were a year ago. Who would have thought financial markets would swallow this huge amount of borrowing that's being done? And how is the UK government and others paying for all this pandemic? Well, as I said, it's borrowing by issuing lots of debt, which is running up deficit. And who's buying it? Well, 95 to 98% of UK government debt issued over the last 12 months has been bought by a very accommodating buyer, Mr. Andrew Bailey of the Bank of England. Who would have thought that there is a money tree? It's a huge money tree. And what we need are these two aspects of financial policy, the ability and willingness of governments to carry on running up huge deficits, and supportive central bank policies in order to ensure that the global economy keeps running over until we get herd immunity. How strong will the global recovery be? Well, the IMF penciling in 5.5% global growth this year, up from a shrinkage last year of 3.5%. And it is that 5.5% is really being led by the US, which many economists now are penciling in 6% plus, which would mean if the US grows at 6% this year, it will have more than recovered from the loss of last year by the end of this December. You might say, where does China come in this? Well, China had already begun recovering in Q4 of last year. And as with so many things, and it didn't have such as bad a hit as many Western economies. So we're going to see the biggest recoveries from those economies that were worst hit, just because you're coming from a lower base. And here we see quite nicely from a chart from Goldman Sachs Asset Management, what we mean by that on a national context. It's a chart showing GDP as it stood. So it's been rebased to zero at the beginning of last year. And you can see, sorry, it was rebased in October the 1st of last year. And you can see how it fell hardest for the UK and least for the US. And consequently, the recovery when it happens for the UK will be greater than for the US. But do take a second look at this chart, because it's quite interesting. What else is it saying? It's saying the second wave that we've had has hit the UK and the Eurozone much worse than the US. A lot of the US actually stayed open during the second wave, or to a much greater extent than Europe did, and that it did in the first lockdown. And that aspect of time in the UK is worrying, because it suggests that furlough schemes and support that are due to be unwound from September may need to persist. Whereas in the US, it looks pretty much that the 1.9 trillion stimulus package that the Congress has just approved will be the last such measure that's needed. And Eurozone sitting somewhere in between. Certainly a strong dose of fiscal stimulus in the Eurozone wouldn't go amiss. However, you're always up against the Germans and their fear of Weimar Republic inflation, etc., when you suggest that. Oh, and they're worried, of course, that the Greeks get a bit carried away with fiscal laxitude and other Latin nations. And there are buts to this scenario that I've just painted, which is broadly optimistic, as you probably have gathered. I'm first of all going to look at the economic buts, the concerns concerning economic policies, and that is that will unemployment go up once furlough schemes and stimulus packages have come to an end? Are there lots of what's called zombie companies that are only in existence still because of government handouts in the developed world? If so, current unemployment data may prove to be illusory. And if we're going to see a spike, well, guess what happens when you have an unemployment in spike in unemployment? It's not just that those who are unemployed stop spending. It's everybody around them stops. Their families stop. Their former workmates that see an empty chair next to them, well, not in this climate if they're working from home, but people around them stop if they sense that unemployment is rising and their job's at risk. A small increase in unemployment can have magnified effects on discretionary consumer spending. And there's nervousness over aspects of economic policy. Modern monetary theory you might have come across that was poo-pooed by central bankers a few years ago when it became very popular, basically saying central banks can finance government deficits forever and ever, so long as politicians raise taxes and cut public spending when inflation gets going, which of course never happens because that's electoral suicide, political suicide. And that was a problem in the 60s and 70s. That's why it's generally not considered a good idea to allow central banks to finance government spending in that way. But that is what's happening at the moment. And there is nervousness that we enter a period of very lax public finances with too much money circulating. And if inflation does kick off, governments being very reluctant to raise taxes and to curb inflation in that way. And then there's the second feature, which is government debt. It's all very well the UK running large deficits at low interest rates at the moment, but what happens if inflation picks up and interest rates rise, and suddenly you're having to issue new debt because old debt is rolling over, perhaps, or you're having to issue new debt because you still haven't got that deficit down, and you'll be having to issue new debt anyway just to pay the interest on the old stuff. But what if you're suddenly not paying 1% on that, let's say 10-year for argument's sake, but you only pay 2-3%? Your interest bill can climb very, very quickly. And furthermore, the UK public finances are far more sensitive now to any rise in interest rates, because the debt outstanding in the market that isn't owned by the Bank of England, this great honey monster that swallowed up so much of public debt, but the stuff that's actually traded and sets the price signal for debt is now got a much shorter, what we call duration. It's now down to, I think, about four to 5 years, as against the 10 to 12 years it was a year ago, which means any changes in interest rates and inflation affect the price and the yield of outstanding debt to a much greater degree than it used to. And there are buts regarding the vaccines. There are all sorts of supply chain issues and politics that we've read about in the newspaper. Problems of mutant variations, whether it's the Kent variation or something from the Amazon, won't be combated successfully by vaccines. There's the problem of bad science fueling anti-vaxxers, and logistical challenges in poor countries. All of this could lead to a lack of herd immunity around the world. And we have to have global herd immunity. Otherwise, we will have to freeze out, which would be almost impossible, certain countries from the global community. And I just don't think that's possible to do. UK, unfortunately, is going to suffer below average growth this year. The OBR, I think it was last week or the week before when we had the budget, came out with an estimate for growth this year of 4%, a magnificent 7.3% next year, and then falling back to long-term growth of 1.7%. And so really, probably by the end of 2022 or early 2023, we might be back to where we were just before the pandemic. And interestingly, it's suggesting that demand will remain pretty slack enough so that inflation is not forecasted to reach 2% until 2025, which is the answer to my first poll question. Now, you might think that's a long term out, and I'll be coming to why they think that, but I should add there is a huge range of opinions. And just in yesterday's FT, there's an article that quoted Bank of America as forecasting inflation to reach 2.5 temporarily at the end of this year before coming down well below 2 after that. But the general picture we should have in our mind is the UK, despite being one of the worst affected economies from COVID, is likely to have a sub-average global recovery, which is quite unusual because, as I said, that base effect should lead to a much stronger recovery. But as I showed on the earlier chart, the problem is it's being pushed out over time. And that, as I said earlier, brings with it fresh risks over will furlough schemes and so on continue to be there to support. What are the more structural problems that are bringing down the UK compared to the temporary ones? Well, the temporary ones are, as we know, COVID-19 and the fact that the UK economy is biased towards services, especially people-facing services such as travel, hospitality. So they've been hit much harder than manufacturing, which is why Germany was able to come out of that first lockdown earlier than we were last year, because more jobs are in. I'll rephrase that. Why German growth was stronger in the second half of last year than the UK, because more jobs are in manufacturing and factories than in the service sector in the UK that remain closed. And we've got Brexit teething problems on the temporary side, but we've got some strong structural problems as well. We have got a perennial problem where there's an interlink between our dysfunctional housing market, where supply simply is not price sensitive. It's in the interest of developers to hog land as the price goes up, rather than build houses, which is perverse. Good article by Martin Wolf about this in yesterday's FT, by the way. And that in turn leads to displacement of labor. So we've got skills in the wrong parts of the country from where they're needed. And that has contributed to weak investment over the years. And Brexit is a structural investment problem as well. The amount of inward investment in the UK stalled in 2016 and hadn't changed over until the COVID crisis, and then it fell because of uncertainty over Brexit. But there are all sorts of issues over structural issues over Brexit. really, because if you leave a market of 300 million consumers, where the people in charge say you cannot be outside of the market on the same terms as you're going to be in, you are going to have to suffer the deterioration in terms of trade. And so our agricultural produce, for instance, have more barriers to jump through even than New Zealand, apparently. This is because New Zealand has agreed, along with Canada in its trade deal with the European Union, to converge many of their regulatory laws, whereas we've actually said we're leaving because we want to diverge. So we've got a suboptimal trade deal. And finally, GDP accounting is quite interesting. The UK actually counts its GDP from the public sector in a different way than many continental European countries, and that leads to an over-pessimistic accounting of output, which is quite interesting. That you can find quite a lot of this on the web. Economists are working on it at the moment, but it could mean that on a like-for-like basis, the UK economy didn't fall as much as 9.9% last year, perhaps closer to 5 or 6%. That's work in progress from economists, but it's worth being cognizant of. Inflation. What's wrong with a bit of inflation? After all, if you're a debtor, if you're a mortgage holder, if you're the UK government owing all that stuff, owing all that money, surely you'd like a little inflation to eat away at the real value. It not only does that, but it allows prices to adjust more easily. If you've got workers in one sector that aren't being as productive as others, and you've got some inflation, well, the wages in the first sector don't have to go up quite as much as wages in the second sector, and so you can have changes to relative wages can come in, and relative changes in relative prices can come in, with nobody's price having to actually fall in nominal terms. Who wants their wages to go down? Nobody. But it somehow feels a little less bad if you know your wage is only going up 1%, but somebody who's more productive is going up 2%. So it actually allows the grease in an economy for wages. It allows relative wages to change, which is how economies progress and change. It also spurs consumption and investment, because if you're sitting on money that perhaps is earning nothing in the bank, or even negative after inflation, it spurs consumption. And moderate inflation is good for stocks. It does actually boost stocks relative to cash and bonds, because companies can pass on that inflation through their prices, whereas bond markets, obviously, you lose in real terms. But obviously, there's a downside. Bond markets hate it because they are the people who receive the capital back and the interest coupons, and every time they receive those, they're worth less in real terms. And so if you start having inflation and you've got a bond market that reckons it's being diddled by you because you're letting inflation out of the bag, well, then they will charge you a higher yield, higher interest on any new debt you issue. So if you're going to allow the inflation cat out of the bag, you've got to make sure that all your debt is in the past and you're not still having to borrow. And this is where the UK government's going to run into problems, because it's going to be running large deficits for a long term to come. So it's got to be careful on inflation. Central banks must show credibility. Central banks' mandate primarily is price stability. That means to keep the value of money as it is. Some central banks, such as the Fed, have a dual mandate, which is to keep employment, have low employment. But that central mandate of price stability is important, and their credibility starts to suffer if they let inflation out. And then nobody believes them, and then inflation expectations go haywire, and then it becomes very difficult to put the cat back in the bag once it comes through into increased wage demands to meet those higher inflation expectations. And stocks don't like embedded inflation, which I mean they don't like a wage prices spiral such as we had in the 1970s. It deters investment. It encourages currency flight into stronger currencies that you don't have, that don't suffer inflation. And if you want proof of that, just look at the story of sterling against the Deutsche Mark, the Swiss franc, the dollar. during the 60s, 70s, and 80s, where we had relatively high inflation. So what sort of inflation do we have at the moment? Well, at the moment, it is rising in most economies, but it's tending to be through supply side shocks rather than demand. And it certainly isn't being driven by inflation expectations feeding in to higher wage demands like the 1970s. So it's actually, I think, temporary and pretty harmless. Why is it harmless? Because supply side shock inflation actually has within it its own deflationary forces. If you're having to pay more for petrol at the petrol pumps, more for French wine, for argument's sake, and I understand that is going up, then you've got, and your wages aren't going up, then you've got less discretionary consumption spend on other goods. So it should be deflationary in other areas. So I think what we're seeing is a temporary supply side shock that will come out of the data, the year-on-year data over the next year or so. The key thing is to watch for unemployment and wage growth from the third quarter, when in the UK the furlough scheme is coming to an end, and in the US the effects of the Biden handouts that are about to be given out will have come to an end. If we are seeing very low unemployment and strong consumer demand, perhaps because pent-up savings are being spent, then we may see wage inflation, and that would then lead to higher prices, demands for more wages, and then we get into that nasty wage prices spiral I mentioned. It was the curse of the 70s and 80s, but we are certainly not there yet. And in the UK, this is from the OBR. It's a bit of a fussy chart, but the point to look at it is showing unemployment in the UK, and the blue line is showing the forecast from March by the OBR, and it's showing peaking at just over 6% before coming down over the next couple of years, but coming down slowly. And I should add, not peaking until really towards the end of this year. This, I think, relatively high unemployment compared to what we've been used to, will keep the lid on inflation. And I suspect we're going to see this in the US. And in the Eurozone, it'll be a worse chart because of delays in vaccine and their own problems with structurally high unemployment in many of the Latin nations. What's really pleasing, actually, is to see how it's below the central projection of just as recently as last November, and that's the solid yellow line. Why is that? Well, the second lockdown hasn't been as severe on unemployment as we'd thought, and that's generally good news. Well, not generally, it's very good news. So now let's look quickly at Brexit in the UK. It's an ongoing process. When we did the trade deal, that was not the end of the Brexit negotiations. This is partly because there wasn't that much flesh attached to many of the headline details. For instance, when it comes to shellfish from areas of Britain outside of Scotland, which has very pure waters, they have to be purified now before they're exported to France. Britain apparently doesn't have any purification tanks. We used to rely on French ones, and they cost £1 million a go to build. That detail wasn't looked into, or they didn't have time to build these tanks. So these should be temporary things, but we've really got to negotiate still on many aspects of it. Then there's the Northern Ireland border. Do you have the border effectively between the EU and the UK and the Irish Sea or mainland Ireland? That is unanswerable, in my view. There is no answer that doesn't annoy the nationalists or the unionists to the potential extent of breaking up the Good Friday Agreement. And that's going to run and run, I think. And then we've got sovereignty trumps economic rationale. There should be a deal on so many aspects where we've been able to get a deal, but the UK refuses to accept jurisdiction of the European Court of Justice. And meanwhile, because it wants sovereignty, absolute sovereignty over what it wants to do. But I should add, there's an ideological standpoint that the EU are taking, and that is that they they really do not want to see a successful Brexit for fear that it will encourage the others to other countries to leave. So there's ideology trumping rationale, I think, on both sides. And of course, we've got the problem that the agreement in December favored trade, which is what the EU runs a surplus in, but there was nothing on services, which still has to be negotiated, particularly for banking. And the UK is at a disadvantage in that. It really should have got something for banking in the bag as a condition for doing a trade on goods, but the EU didn't want that. So that there's an inbuilt structural advantage favouring the EU that UK politicians hopefully will be spending the next couple of years eating or nibbling away at, or trying to. Longer term issues over Brexit are that, as I said right at the beginning, you simply cannot leave such a large free trade area and suffer worse terms than you had before and expect to be better off. And it does make us less attractive for foreign investors as a gateway into Europe for obvious reasons. Sure, we're tariff free, but we've got all sorts of paperwork and non-tariff barriers, as they're known as. And just when it comes to agricultural goods, you've got, vets now have to be employed to sign off certificates for livestock before they're exported. You've got all sorts of what are called non-tariff barriers coming in that are particularly for punitive for food and fresh goods, where time is of the essence. And there are going to be trade distortions because as imports from the EU become slightly more expensive and exports a little harder to do, there's going to be a bias towards UK trade. That means the UK producers get a level of protection they didn't have before. That invariably induces there's less incentive to remain competitive, and it introduces distortions into any economy when you introduce basically a bit of protectionism, which is what will happen once the UK starts implementing trade barriers on EU imports into the UK, which it hasn't done at the moment. Interestingly, all the barriers are on UK trade into the EU. The EU is saying we're not going to interrupt our own supply chains by doing this, but sooner or later they will, because otherwise they'll be breaking World Trade Organization most favored nation clauses if they don't. In fact, I'm surprised they haven't already been told that by the WTO. But we'll move on. When was the last UK government assessment of Brexit? It was November 2018. And I think that's in the poll, fewer people thought that, where we got a free trade agreement, as this chart shows, and the government made an estimate that it would, over the next 15 years, hit GDP growth by 4.9% if there was no change to migration rules, and by 6.7% if there was no net migration of EU into the UK. As you know, we chose a hard Brexit, and that did mean EU citizens are going to be treated like any third-party country. And so that does suggest a drop of 6.7% GDP over the next 15 years to the UK. You could ask, as many have, why hasn't there been a more recent study? Well, the answer is that there are no economic groups of any standing other than one group, which is called Economists for Brexit, who are positing economic gains arising from Brexit. It wasn't long after the referendum that actually even the government began focusing on sovereignty as the big gain rather than any economic gain. Just a quick word here on Matthew Woods, if we may. We run a number of multi-asset funds that really are multi-asset. We go way beyond conventional bonds, equities, and property. We include private equity, gold, alternatives such as real return funds and structured product funds and so on. And through that, we try and reduce the amount of risk that each fund is taking through this diversification. And on our growth and adventurous fund, we are beating the benchmarks. And as I said right at the beginning, Morningstar have been nice enough to award us a 5-star on the adventurous fund. And long-term themes that we're pursuing are tech, no surprises there, healthcare, no surprises there probably, Asia growth. I should add, we are going broader than just China. We're interested in India, ASEAN, the whole Asia region. We like gold, not just a hedge against inflation, but also it will have strong demand as Asia gets richer and wants more jewelry. And it is also a good hedge against geopolitical risk. And we like the environmental theme as well. Near term, we are becoming more focused towards economically sensitive sectors, cyclical stocks, and we are decreasing our exposure to cash and government bonds. Now, quickly, how are we responding to inflation? We are engaged really in the rotation away from government bonds into risk assets such as equities and real assets such as gold. And this threat of inflation and the fact that bond yields are coming from very low levels is really putting pressure on conventional 60-40 portfolios, 60% equities, 40% bonds. Because frankly, if equities do fall out of bed because we suddenly enter a recession for whatever reason, traditionally bonds would give you growth, but bond yields are already very low. And so they don't actually have much further to fall to give you that capital growth. And meanwhile, we actually fear inflation as by far the biggest risk than deflation. And so we actually think the bonds are going to give you negative return in nominal and in real terms. And another rotation we're doing, so that first rotation is away from government bonds into equities and real assets such as gold and property and private equity within our multi-asset fund. The second theme of rotation is from the jam tomorrow stocks such as tech into jam today such as value, and that might be the deeply distressed sectors in mature industries that once they return to profitability with the return to normality of the global economy, we'll see a huge increase in year-on-year profits and dividends. So this might be hospitality. We've already seen it in mining, and we're seeing it in industrials, in financials. I should add, we're not very keen on European financials. The US financials look quite solid in today's environment. These assets look good to us. Now, you might ask, well, why hasn't NASDAQ suffered more? If we, along with, I should add, the rest of the investment community is a bit hesitant on growth, well, the NASDAQ is dominated by some very big companies that are already offering jam. They're already in profit. And these are much less vulnerable to any switch by investors. I'm not qualified to talk about individual stocks, but for illustrative purposes, Apple, Facebook, Microsoft, these are profitable companies. But then there's a whole raft of large tech companies that are still in the offering profit sometime in the future. In fact, Tesla, I believe it has a larger market cap than Toyota, isn't yet, I believe, offering a profit. Is very much a jam tomorrow. And that is very vulnerable to increase in interest rates, in bond yields, to finance future growth. And because investors are seeing higher returns from bond markets as yields go up, so that's attractive. And they are seeing these companies, and these mature companies, suddenly returning to profitability with good yields. So why not go for that? So thank you very much for watching this. And any questions, do please ask them.
Tom, thank you very much indeed. Just let me have a look. A question for you. What are your thoughts on crypto assets?
I think, does that sum it up? As an investment, we don't like them. Just think of them. Cryptocurrencies started off, well, they've got currency in the name. They pretend they're money. But what do you want from money? You want stability. If you're the owner of a cryptocurrency, you want to be able to buy your Kalashnikov on the dark web for the same amount of crypto coins from one day to another. And the seller of the Kalashnikov wants to know that when they've sold it for a certain number of Bitcoins, that Bitcoin will hold its value as long as he's got it. But why are investors buying Bitcoins? Because of the volatility of them. And sure enough, over the last 12 months, we have seen, apparently on the dark web, less use of Bitcoin than we did before, than we did last year. Because the increase in volatility makes it less use as money. So in effect, it's electronic gold. It's not producing an income. Its only value is that you're hoping somebody will take it off your hands for a higher price. But unlike gold that's been around for thousands of years and has a universal value, crypto doesn't have that. And we are very hesitant about using it in our portfolios.
Right. No, thank you very much indeed for that. Right, you're going to have to bear with me here because I've got a fair bit to read out. And thank you, John, for your question or your thought. It is clear that the UK and UE economies will see different levels of recovery as a result of the Brexit issues and the EU's determination to protect the integrity of the single market. Do you think we are going to see a long-term gradual decline with the UK becoming a sick man of Europe, similar that's seen in the 20 years or so that the UK were outside of the customs union during the 1960s? Will economic interest override political interest?
Interesting. A lot of economic historians will give the reasoning for our really strong growth relative to Europe in the 80s and 90s to two things. First, joining the EU in the 70s, and then Margaret Thatcher pushing for the single market. And the second thing was the Thatcher supply side reforms. And the combination really driving the UK economy. We have obviously removed ourselves from the first, but the second is alive and kicking, and we have a much more mobile, fluid labour market, despite the problems with housing that I said earlier, than continental Europe. And and that is going to be our strength. It's going to be a flexible, cheap workforce, which isn't very nice to say, but I think we'll do okay because because we've got a cheap workforce. It's to be hoped that the government's initiative on tech, with lots of R&D spending, leads to investment in high quality jobs and research. But I rather suspect that our advantage for manufacturing, say, manufacturing goods that we continue to sell into Europe, will be a relatively cheap labour force relative to France and Germany.
Okay, no, thank you for that thought, Tom. When you are referring to bonds, are you making reference in particular to the UK bond market or world bonds?
Sorry, when a lot of people like me talk about bonds, we're really talking about US treasuries, because that's the ultimate risk, what we call risk-free asset, the one that is most unlikely to default. And it sets the tone for the global bond market. When the US Treasury yield goes up, other countries' yields tend to follow, and vice versa. So I'm really talking about that. Specifically for the UK gilt market, I suspect yields will go up as inflation picks up a little because of the supply side shocks I was referring to that will unnerve parts of the market. But I don't think they're going to go up that much. And I can see them then coming down again in a few years' time, along with those in the US, actually.
Thank you. A question, a point from Jan. As Germany is printing Deutschmarks, do you think they are preparing for the fall of the EU?
Oh, there are lots of these stories. I remember when I was at JP Morgan, I used to look after Greek clients during the crisis, and all these stories about Greece printing drachmas in caves in the north near Halkidiki, just waiting to be filling out the bank machines if they left the euro. And then there's another story that euro notes all have a code that identify which country they were printed in. And if the euro breaks up, those codes will identify who gets which euro. I don't know if that's true. I did do some research and I couldn't find any evidence. Germany is not going to voluntarily join the euro. Why? Because it's the Latins that keep the euro cheap. That is why BMW sells so much into America, because the euro is cheaper than it would otherwise be. And if Germany and the Netherlands, especially, the Netherlands is running a huge current account surplus, 8% of GDP. The guilder would go way out into orbit, making Dutch exports, tulips. I don't know what. Well, actually, I do know what else they export, but we don't go there. And they're much more expensive. And so they wouldn't. They'd be mad to leave the euro. Now, except there are right-wing groups in both countries that, as a matter of principle, want to leave the euro. But it only takes a moment of explaining, I think, by politicians on the left and the right, the huge impact on their export sectors and on jobs if they were to do that.
Okay, thank you. Thank you to Salman. Question here, Tom. If government bonds fall, then what will its effect be on interest rates?
Government bond markets, if you like, control the cost of borrowing outside the very near term. The overnight rate is set by the bank rate, by the central bank, affected by what we call market rates, bond rates. And your 10-year fixed mortgage, for instance, is much more influenced by the 10-year gilt and the yield that that's trading at than the overnight interest rate that the Bank of England sets. Now, if the Bank of England increases interest rates, that will feed through into what we call the longer end of the yield curve. But what really matters when you're that far away from the overnight rate, as far as 10 years, is what the market demand is for 10-year government paper. And if we see a fall in UK gilts and because of lack of demand, perhaps because of inflation risk, and a consequent rise of yield, because of course in bond land, the yield is the inverse of the price, we will see increasing costs for 10-year mortgages, for 10-year corporate borrowing, and so on. And that will have a deflationary effect. If the cost of borrowing costs more, there is less demand for credit, which means there is less demand for money and less growth.
Yeah. Okay. Thank you, John. Hopefully, I'm asking this question correctly for you, Tom. It is: would you invest in UK businesses? I see big opportunities for mergers and acquisitions. Would you agree with this? I have seen it before when coming out of a recession. Absolutely.
For exactly the reason that's inferred in the question. When you come out of recession, there are a lot of good companies that unfortunately have perhaps been run badly. They've slipped on banana skins, and horrible for the founders who built these things up. But the facts are what the facts are. If they've gone bankrupt because they made an error, they can be bought for a song. Now, the problem with this now is, as I referred earlier to what we call zombie companies. The problem is there will be a lot of companies that should have been allowed to go bust, and administrators now should be selling them to those who have the money and the resources to take them on and manage them well, but have not yet gone bust and believe they can carry on and on and on because of furlough schemes. Let's wait to see what happens. And so this is going to hinder the recovery. You can see this since the welfare state was created. In the 19th century, companies went bust in recessions and their assets were picked up by competitors. The moment you start having the welfare state come in, it blurs this, makes it harder. And believe me, we've had the mother of all welfare states come into the corporate sector over the last year that muffles the signals that should be sent from struggling companies that should say, buy me, save me. Instead, their owners are saying, I'd rather hang on. The government's letting me hang on.
Right, thank you, Tom. I think I've managed to bring us in on, and thank you, Tom, we've managed to bring this in on time. So thank you, Tom, for your time and your contribution. Really enjoyable, very insightful update. And intriguingly, it's posed a number of questions, which is good. So Tom, thank you very much indeed for your time and your contribution this afternoon. There were a couple of questions from members right near the beginning of Tom's talk that weren't related to his talk. If I cover those off, for the foreseeable future, yes, we will be delivering CPD through the various webinars that we post and what we put online. Please visit the Institute website for all of the information and the registration links. I was also asked a question about membership certificates. Members will be sent the appropriate certificates. So again, please bear with us if you were listening to me at the very beginning. Due to the COVID situation and environment we find ourselves in, apologies, but things are a little bit delayed, but I'm sure you can understand where we're at there. Any queries, any questions, please do contact us. And there was a question with reference to the website. I will find out the answer to that and come back to the person who asked that question. So thank you very much indeed. Tom, thank you for your time this afternoon. To everybody who's attended, I do hope you found it useful. I hope you found it enjoyable. And we look forward very much to seeing everybody at the next National Institute branch meeting. For now, stay well, keep safe, and have a good afternoon. Thank you all. Bye-bye.
Thank you.